This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We are hosted by me, Benjamin Felix, and Cameron Passmore. So we're hearing from more and more people who are listening to the podcast, which we both kind of find, I think, a bit surprising. We started this thing thinking that maybe some of our clients would be interested in hearing us chat about what's going on and what we're thinking about. But there are a lot of non-clients and people that I don't even know who seem to be listening to the podcast. So that's been kind of neat.
You've been asking how to access it on different platforms and different devices.
Yeah, we've had people reach out on Twitter, LinkedIn. I've had some emails. It's crazy.
Question came in this week as well, which we'll answer later on.
Yeah.
So keep the questions coming in. It does make it certainly more engaging for us as well.
Yeah, definitely. And if you are listening to the podcast, it would be great if you could rate it on whatever podcast app you're using. And if you want to leave us a comment too, that would be awesome. It's been really interesting hearing from people that we don't even know since we started doing the podcast.
Yeah. So I was out in BC last week, right near where you were born and raised. It's so beautiful out there in Victoria. Unbelievable how much smoke there was out from the fires. Really sad. The friend's house I stayed in, they had to actually unplug their smoke detectors. It was so bad.
Wow.
And I saw people out there actually that mentioned they were listening to the podcast. They're on our newsletter list, but they enjoyed it, so that's kind of nice.
Yeah, that is nice.
So what's new on the home front?
Oh, well, we had the third addition to the family a couple of weeks ago. I think we're pretty much settled in at this point. I did a couple of we had to do an iteration each night because my oldest son was having some trouble, but we made adjustments each night, and I think we're all good now. So that's been a pretty smooth transition, all things considered.
Is there anything happening in general across clients recently that come to mind?
Like kind of questions that have come up?
Well, it's one thing that I've noticed this past couple of weeks, that a number of people are buying houses, and it seems, on a very small sample, granted, but it seems that housing prices are coming down, where people are actually bidding under ask. I don't know if that's because the asking price is going up. I don't know all the details, but these are in pretty hot neighborhoods, and they were going below ask. So.
Wow. I talked to somebody a couple of days ago where they had the opposite experience. They lost out on a bid, and then in the next one that they went for, they went way over asking. So different. Your sample size was too small.
Perhaps. It's still nice to see them get the house that they wanted and not have a crazy bidding war, which is what we hear from our clients in Toronto, where it's just mayhem on the
Well, Ottawa's been crazy this year. We've had a lot of people lose out. Anyway, last week something that happened was maybe we'll talk about whether it happened or not. But the longest bull market in U.S. history may or may not have occurred last week. And I'm saying may or may not because there's some debate around how you define a bull market, and it's all a little bit subjective anyway. Most people kind of agree that a 20% decline defines a bear market, and therefore the bull market would start when that ends. But the 20% is also arbitrary. There's no reason that it's at that level, and the U.S. market has had some fairly substantial drops over the time that some people are saying has been the longest bull market in history. So whether or not those would be considered bear markets or not is, yeah.
But to think back to when this bull market started, it was horrifying to be in this business, but even just to be a normal person working in North America, it was awful.
Right.
And talk of food stamps and lineups and what could collapse and pensions, and it just went on and on and on. And I can tell you, living it every single day, you could understand how many people could not see the way out of this, let alone to have, almost 3,500 days or something of almost straight line growth, it feels like. And you have a whole generation of investors that have never really seen down markets.
Well, the current generation now, that's where we are. There are definitely a ton of people like that. And views on investing have changed too, with the rise of index funds and the idea that you can't really do anything to outperform when the market crashes. It'll be interesting to see how this generation of people responds if that does happen. Anyway, when the market's rising or hitting all-time highs or having the longest bull market in history, all these different things, it makes people start to worry that it's got to be at the top. Like if we hit an all-time high, it's got to come down. Or it's been the longest bull market in history, it's got to come down.
And how many times have you been asked that question lately?
Well, I just got an email this morning about that exact issue. Like it's been such a long bull market, it has to come down sometime. And that's, I mean, I guess kind of inherently true maybe, that, or at least it has to be possible that it could come down at any time, and that's the risk of investing in stocks. But we looked at the previous all-time highs in a couple different markets. So we had from Robert Shiller's website data for the U.S. market, price only, so not including dividends, and that would change it a bit. Mm-hmm. But price only going back to 1871, the U.S. market has hit all-time highs in 16% of months. So 16% of months since 1871 have been months where there was an all-time high.
Wow.
Yeah. Pretty interesting. And then we looked at what happens after an all-time high. And in 67% of months that had an all-time high, the next month was also an all-time high. So it's not like the all-time highs indicated a drop going forward. And the data was almost exactly the same for the MSCI EAFE and the S&P TSX. So that's representing developed international markets and Canadian markets. They had a relatively higher number of all-time months with all-time highs. I think it was closer to 30%. I didn't take a note of the number though, but it was in terms of months following all-time highs. It was again, I think it was 63% for the EAFE and 67% for the S&P TSX.
But the fact that people are asking, is the market about to crash? And I'm worried about it. That kind of lends me to think that many participants are thinking this, which is priced into the market.
Right.
Very different than, say, back in 99, 2000, where everybody just saw things going up forever. Yes, we're at an all-time high, but the conversations don't feel like that.
Right. Feels different. We always have to remember, too, that all the media coverage, or most of the media coverage, is about the U.S. market. And yes, the S&P 500 has had some crazy growth. International and Canadian stocks have not been growing at rates higher than we would expect based on long-term averages. Obviously, that who knows what that means, but the U.S. market has been outpacing historical growth, which is, I think, what makes people scary. I saw a post from Ben Carlson last week, I think. I didn't read the full post, but maybe it was a tweet. Anyway, it said that earnings have actually outpaced returns in the S&P 500. So
wow.
If people are worried that it's getting out of control or whatever,
it's not even keeping up.
It's the economy. Actual earnings growth
wow.
is outpacing price growth for the S&P 500. So I thought that was really, really interesting. PWL's research department does cheap rich analysis. How much value is there in that for what we do? Who knows?
For information purposes, not trading purposes.
But
sure.
It's interesting information. And
the higher the multiples, the lower the expected return. We don't use it for any more than that.
Well, we use it for financial planning.
Yeah.
For developing projections. But for whatever it's worth, PWL research view is that Canadian and international stocks are currently fairly priced. U.S. stocks are overvalued by 22%. Emerging markets are undervalued by 18%. But the point of that is, markets aren't crazy out of control.
And all of our portfolios are globally diversified, rebalanced regularly. So you're getting exposure to all those markets.
Yeah. And even if markets were hot, so like say the U.S., it is overvalued a bit. There's that old Vanguard paper that looked at all the different valuation metrics to see if they could be predictors of future returns. And they tested a whole bunch of different ones. The best one was the Shiller CAPE, so the cyclically adjusted price earnings. That's the price over 10-year trailing earnings. And they showed that it only explains, so it's the best one out of all these different metrics that they tested. And it only explains about 40% of the difference in future returns.
Right.
So the best metric is not great in terms of actually using it to make investment decisions.
So this kind of leads to the listener question from last week, which we get fairly often, which is if you have a bunch of cash from whatever, selling options or sale of a business or inheritance or something, and you want to invest, should you invest as a lump sum or dollar cost average it in over time?
Yeah, it's a good question. Common question, like you said. The number, the 67% number that we were talking about with months, all-time high months being followed by all-time high months was 67%, and That is the exact same number of months overall where the market is increasing. So the market's increasing in general about 2/3 of the time.
Yep.
And based on that, and this is actually another Vanguard research paper they did a while back, but based on that, at any given time, investing in a lump sum gives you the better outcome about 2/3 of the time. So if we're saying what gives you the positive expected outcome, it's investing in a lump sum.
But some people just have a preference for pulsing in it over time. So if you have $1 million to invest, you can put in whatever, 100,000 a month for 10 months. You can see the emotional appeal. But I remember sitting with, had the luck of having breakfast once with Ken French and asked him that question. And he said, what matters is the riskiness of what you're investing in, not when you're investing in it. He was quite categorical about it. Doesn't matter when, just do a lump sum.
In a risk-appropriate portfolio.
Correct.
I think that's the big thing,
That's
right?
the big thing.
Like someone who's going to retire tomorrow, they're not going to invest in a lump sum in a 100% equity portfolio.
Of course not.
But they might invest in a lump sum in a 50% equity portfolio. I don't think there'd be a problem with that. But the answer to the question is it's optimal statistically to invest in a lump sum, but for actual humans who are investing, a lot of the times they don't feel comfortable doing that.
Yep.
Now, when you explain that to a lot of people, they'll say, "Oh, just do a lump sum," because they don't want to think about it. But if someone's nervous, then we will do dollar cost averaging. And I would say with people that we talk to who are actually doing this, investing in a lump sum of cash, I don't know. I don't have actual data on this, but I would estimate somewhere around 50-50 where people want a dollar cost average versus doing it in a lump sum.
Yeah, maybe a bit more as a lump sum.
Yeah.
But it depends on their starting point too, and what percentage of the net worth are they investing. And
I think that along the lines of what Ken French said, the biggest thing is the riskiness of the portfolio. And either way, whether you dollar cost average over a reasonable period of time. So if it's over a year or 6 months, if it's over 10 years, that's a different story. But if we're dollar cost averaging over a reasonable period of time versus lump sum, I don't think it's going to materially affect your ultimate outcome.
But sitting on the sidelines, holding on to that cash to wait for a market correction to buy in, that's not a winning strategy for sure. You might get lucky, but it's not a persistent strategy.
That's exactly, getting lucky. We did a post on that a while ago. I think it was the end of 2015 that we wrote it, but it was talking about if you invested a lump, we obviously had the benefit of hindsight. If you invested right before each market crash in recent history, how would your returns have been? And I think a lot of people might think they'd be negative. But if you held after each crash and just kept holding on, even though you didn't invest your next lump sum and markets crash, which hurts, but over the long term, you ended up with a very reasonable return, obviously far better than sitting in cash. So even if you are taking the emotional hits of those crashes, your ultimate outcome is still pretty good.
Yep.
As long as you're getting invested, and that's the key, is getting invested.
So Canopy.
Yeah, Canopy growth.
Man, it looks so obvious in hindsight.
Yeah, so they're
change in policy with new companies developing, the Hershey plant, Smith Falls, like the perfect story to make a killing.
Yeah.
So obvious.
Yeah.
So, I mean, it comes up all the time. It's so obvious.
Are you joking or are you serious?
Well, it's so easy to write this script now that it was easy to have made, what was it? You could have bought it for $2 and now it's at $60. So a 30 bagger on that.
That's a real question. So I did want to ask you, actually, you said it before I asked the question, but when it was at, say, $2 or $3, was it an obvious buy? Knowing what we know now, obviously it is obvious. At that time, was it obvious?
Well, it would have been obvious to have sold it at 4 or 5 because you made 2-3 times your money, right? Which the story I told 3-4 weeks ago with my shares of JDS. Would you have held on to 50, 55? Now it's 60 today. Just keeps on going. Would you have held on after Constellation Brands bought in? Who knows what you would have done? It would have taken a lot of guts to have hung on with a lot of cash for that long. I can tell you that much. But I think back to when they started raising capital, but it went, where did it go public at? I don't remember the number, but it would have been the handful of dollars. Why did they let go of equity at such a low price if it was that obvious they were going to go through the roof?
That's a great way to look at it.
Why would they have done it?
That's a great way to look at it.
Clearly it wasn't risk-free.
Yeah. And there were so many people who did make money. Well, so many. You hear about the people who made money. Obviously, there were probably a lot of people who lost money too. But people made money investing in Canopy and other weed stocks when they were at relatively low prices, and they went up in price and like, oh, this was so easy, it was so obvious. I don't think that's the case. And like you said, with the prices. I think that there were probably a lot of people who did the opposite of what you said. They bought at 4 and sold when it went back down to 2. Or maybe they bought at 30 and sold when it went back down to 20. To hold from 2 until now, that's
with a lot of money.
Yeah.
Because you have just a little bit of money
right.
and a big portfolio, it's not relevant.
Yeah. And then it doesn't matter anyway.
So to have an impact, you have to put a big chunk down, let it grow to be a bigger chunk, and keep hanging on. That takes a whole lot of behavioral fortitude for sure.
Yeah, I think this stuff is never obvious. But at this point, Canopy is bigger than, in terms of market cap, bigger than Bombardier.
Unreal.
Bigger than Canadian Tire, bigger than Metro, bigger than S&C Lavalin, edging up on Shopify, which is obviously one of the most storied companies that we've had in Canada for a while. Still a ways off of Molson, but their market cap's growing like crazy.
Yeah, it's like $13-14 billion market cap.
Yeah, it's unreal. And they've got international expansion going on. I saw one headline that said that they could be the Google of pot, which I thought was kind of funny. But it seems like they do have a bit of a leg up on the competition and all this stuff. So this leads me to the next question that I wanted to ask you about Canopy. So we talked about, was it obvious at the time that it was a buy when it was at $2 or $3? Now it's at, I don't know what the price is, I haven't checked since this morning, but say it's at 60. If it's at 60 now, is it an obvious buy from here? Is it going to go up more than the market going forward?
You're asking me,
I'm
of all
asking
people?
You. What do you think? How would you answer that question?
What do I know that the market doesn't know?
Yeah.
Nothing. There's a whole lot of analysts pouring all over this. There's a whole lot of interest. And you have to be right now on the buy side. So that means someone else is wrong.
Right.
And then they have to be wrong again to overpay you on the sell side later on. Maybe.
Yeah.
You could have bought this, 2 weeks ago for $38.
Right.
Could have made a quick $22 in 2 or 3 weeks.
Yeah. I think that the thing is that it's like what you said. What do you know that the market doesn't? The price has to rise for the price to rise faster than the market going forward. The company doesn't just have to do well, because the company doing well is already priced in. The company has to do better than current expectations. Right. And nobody can know that. The company doesn't know that. We don't know that. So it doesn't a successful company does not necessarily mean a share price rising faster than the market.
No.
It has to beat expectations. And if it doesn't, it'll drop from where it is, right? That's one of the tough things. And this is still such a new market. Nobody knows how things are going to play out. Ontario changed the rules on who can sell, and
it would be neat to know who owns these shares too, like how much of it's institutional, how much is individual. No idea.
That would be really interesting.
Let's see what the volume is on it.
So in terms of public listings, obviously we're talking about Canopy, which
7 million shares traded today, so there's a lot of
volume.
Shares moving.
There was an article I saw, I think it was New York Times. There were a couple different publications writing about this actually, that the number of publicly listed stocks in the U.S. is decreasing. So I found the data. The number of publicly listed U.S. stocks was around 7,000 in 1997.
Yeah, this surprised me.
And it's down at 3,400 at the end of 2017.
Incredible.
So far less in terms of number of shares. And the average market cap of the remaining companies is increasing. So that's all interesting. And the articles were basically saying this is a bad thing and it's not good for the economics or it's not good for the market. As always, we like to look at the global data to see what's going on other than the U.S., and the story's been very, very different. So from 1990 through 2017, the number of ex-U.S., so global ex-U.S., public listings rose from 9,739 in 1990 to 39,333 at the end of 2017.
So fourfold in 27 years.
So if you're worried about the opportunity set shrinking, maybe in the U.S., does that matter or not is a whole other story. But the opportunity set globally does not appear to be shrinking. It's, in fact, increasing.
Is that because the buybacks are much higher in the U.S., perhaps?
I don't think it's got a whole lot to do with buybacks. That maybe decreases the number of shares outstanding. And if capital is being returned through buybacks as opposed to dividends, that could be increasing the share price.
Yeah.
But I wouldn't blame it on buybacks. Mergers probably, maybe companies choosing not to list because there are more regulations in the U.S. market, which is true, and that's not a bad thing for investors. Like if we look at private companies like Theranos, which was obviously a massive fraud. If you think about that, first of all, would they have been able to go public? Probably not. If they had been a public company, how long would that fraud have lasted?
Not long.
Yeah. So all of the disclosure and regulation, I don't think it's a bad thing for investors.
There's still plenty of companies for diversification.
Yeah. There are tons. Now, public companies have had frauds in the past. Like if we look at Enron, obviously that was a major issue.
Yep.
But in that case, the auditor, Arthur Andersen, was complicit
Yep.
in the fraud. So could that happen again? Sure, I guess. Yeah. And if there are fewer shares, there was an interesting piece of research that Dimensional Fund Advisors did on this. If there are fewer shares, does that affect the ability to capture factor returns?
So factor being the size, so the small cap premium and the value premium.
Value profitability.
Yeah.
The dimensional piece just looked at size, but same idea. So they looked at is there a relationship between the number of shares, and they looked globally. Is there a relationship between the number of listed companies and the existence of the size premium? They even looked at a hypothetical U.S. market where they only maintained the largest 3,400 stocks. And in that case, they did still find a size premium. But I have a quote from the conclusion of the paper that says it better than I can. So in the dimensional paper, they said, we observe a positive size premium in big markets, in small markets, in markets which naturally vary in size through time, and in a hypothetical market that does not vary in size at all. So that was that largest 3,400 stocks. Taken together, this evidence suggests that while the size of the market and the performance of different asset classes will fluctuate across countries and over time, there is no compelling indication that a smaller number of publicly listed stocks is correlated with a smaller size premium. Instead, it is more important to consider all information and prices about expected returns, such as information contained in profitability relative price, in addition to market capitalization.
So it's a relative story. So you have 3,400, even though they're larger on average than they have been historically, you still get a small cap premium because there's enough dispersion in returns based on size.
Right.
And not. That's really interesting.
Right. And it's all about the risk being priced in to the price. So regardless of the number of shares, you can still capture these factors, and you can still build a well-diversified portfolio.
So you think of a country like Canada, which doesn't have the breadth of the U.S. market.
Right.
As long as you have dispersion in returns that will be explained by small cap, you'll still capture that effect, even though it's a more narrow market.
Yeah. Yeah, I mean, Canada's a great example. And they actually, in the dimensional paper, they look at a whole bunch of different countries with way less shares. But if we're worried about a decreasing number of shares in the U.S., decreasing to 3,400, and you look at the number of stocks in Canada, it's way less, and it's always been way less, and will probably continue to be way less. But does the Canadian market still have a positive expected return? Yes. Are companies still raising capital in Canada? Yes. Are they still doing well? Yes. So I'm not very concerned about. And you think about what's the alternative? Companies stay private, and then we talked about a minute ago. There's less regulation, less disclosure. It's riskier for investors. Yeah. So I'm not overly concerned about a declining number of publicly listed stocks.
So the size premium question comes up a fair amount because the returns have not been there recently, and there's a ton of research around this.
Well, the returns haven't been there recently, sort of. But this is the thing with the size premium, right, is that people look at small cap indexes, and if you look at a small cap index, the returns haven't been great. But that doesn't tell the whole story. So the research
it does if you focus on recent returns.
Well,
which is not
it's about
statistically sensible to do.
It's about taking all of the research into account when you're looking at small stocks. So the research says, yes, it does say that small stocks outperform large stocks over the long term. But there are multiple layers, right? There's the size premium. You've also got to look at the value premium, so that's relative price. And you've also got to look at profitability. So these are three very well-researched factors. And in the investment products that we use, those are the three factors that are used to sort of tweak the weightings relative to the market. But the thing about the small cap performance is that we know, so based on all those three pieces, size, relative price, and profitability, small stocks tend to outperform large, value stocks tend to outperform growth, and high profitability stocks tend to outperform low profitability stocks. If you sort the market by those three factors, and you take the small cap stocks that are categorized as growth and that have low profitability, that category, so that's small growth, low profitability, they have the worst risk-return characteristics of any category. So to really look at the small cap return, if you're thinking about just small cap in isolation, returns haven't been great. But if you take out the small growth, low profitability, small cap return looks pretty good. So if we just talk about small cap in isolation, that ignores the rest of the research.
Right.
Why would you do that? Why would you look at one piece of the research and ignore the rest?
Right.
But all the conversation around the size premium having disappeared and not existing, I don't really buy it.
And this is something typical indices don't do. They don't go and take out the small growth, low profitability stocks.
Yeah. So I looked at just for this conversation, I looked at the U.S. market for the past 10 years. So very common comment that while over the last 10 years, U.S. markets underperformed. So the Russell 3000, which is the total U.S. market, has returned 10.23% per year on average in U.S. dollars. The Russell 2000, so that's the smallest 2,000 stocks, it's a subset of the Russell 3000. It's returned 10.6% over the last 10 years. So barely a premium, like not enough to
37.37%.
Not enough to really worry about, especially probably after costs, because small cap funds tend to have higher expenses. Now, dimensional fund advisors, and I wouldn't say that this is biased data because they're just sorting the index based on their research, but the dimensional U.S. index, which is an index of U.S. small cap stocks with the removal of the small cap growth, low profitability, and the higher weights in the small cap value, high profitability. So that's how they structure their actual investment products, and this index is following the same methodology. Over the past 10 years, it has returned 12.02% on average per year in U.S. dollars. So we've gone from probably no premium after costs to a fairly reasonable premium.
Yeah, it looks some normal type of premium that you hear the academics talk about.
Right. So anyway, that's something that's kind of been bugging me because I've seen a few different sources talking about how the small cap premium is gone. And it's like, yeah, if you depending on how you look at it.
If you look at the indices, the public indices, you can see that.
It doesn't look great. And I was thinking about this when we were preparing for this show. I was thinking about this exact thing. Well, it's been on my mind, but then I started thinking about, we talk about one of the things that people pay us for is behavioral coaching. And people think, my perception is that people look at behavioral coaching and think, well, I don't really need that. I don't need behavioral coaching. But anything about stuff like this, where it's out there in the media that all small caps underperforming, and if you're someone who's investing in small cap stocks and you see that small caps might be underperforming, you don't want to be in small caps anymore. So if I'm an individual investor without a ton of time to do research, I'm probably going to go ditch small cap stocks. But we're sitting here thinking about this all the time, and we're obviously familiar with the research, and we're able to say, well, you've got to look at it properly. You've got to take all the research into account.
But it's so much more than typical hand-holding, which I think people in our industry say way too much. We're there to hold your hand through tough times. It's more than that. We're going to give you, this is a great example, the data behind it, what to expect.
Right.
We had those questions last week around expected returns on fixed income. It's no different, right? When you show the data to someone, oh, that's interesting, and adjust their behavior. But it's not just about simple hand-holding.
Yeah, we did pull some good data on the fixed income returns too. I don't have it in front of me, but
the GIC comparison.
Yeah.
2/3 of the time, a 5-year GIC is better than the fixed income pool.
No, it wasn't 2/3 of the time. I think it was 23% of the time the GICs outperformed the fixed income index.
Yeah, I meant exactly.
Right.
Something like that. We'll update that next week.
Yeah.
There's some neat data on why to not get frustrated just because you could have bought a GIC that had a better rate than bonds may have had in the last 12 months.
Yeah, the interesting thing about it is that you do have to endure, just like investing in stocks, you do have to endure some periods of underperformance because bonds are riskier than GICs. Like GIC, you're getting basically a guaranteed return.
And they're priced to market too.
Right.
But at the same time, the expected returns, the returns earned on the equity side of the portfolio were higher than expected. So overall, it was very good returns.
In the portfolio, yeah. But
Yeah,
I do think it's pretty interesting to talk about the difference between GIC and fixed income returns where, it's the same story as stocks and bonds. Stocks underperform bonds sometimes.
Yep.
Does that mean we stop investing in stocks? No, it's a risk premium. You're accepting risk for a higher expected return. It's the exact same thing with bonds and GICs. you will underperform sometimes because bonds are riskier, but over the long term, you expect a better outcome. We can chat about that post next week, but the data was interesting.
Yep. Anything else?
I'm good.
Send in your questions.
Yeah, please rate us on your podcast app. Shoot us a question, send us an email. Love to hear from you. And thanks for listening.
See you next week.